Good morning. You are watching live Daily Market Outlook for Wednesday, 9th of May 2012. Overall situation in the markets remains quite unchanged compared to the previous 2 days, with the Greece still being in focus as the country enters the crisis again after the elections, when the radical left parties actually gained the power. The radical leader of the radical left party meets the leaders of Greece's mainstream parties today to try to form a coalition government, an effort seen as doomed after he demanded the first agree to tear up the country's EU-IMF bailout deal. And basically this is the the main issue of all this story. An inconclusive election on Sunday has basically left Athens in political disarray, with no clear path to form a government. A new election likely within weeks, and speculation escalating that Greece could be pushed out of Europe's single currency bloc. As the waters enraged by economic hardship repudiated the two parties which led Greece for decades, the conservative New Democracy and the socialist PASOK, the only group that backed the 130 billion euro bailout which saved Greece from bankruptcy recently. The remote chance of leftists forming a coalition faded even further on yesterday, when the New Democracy leader Antonis Samaras promptly rejected the demand to scrap the bailout, warning such a move could drive the debt-choked country out of the euro. As the situation still remains quite foggy and unclear, and the most likely scenario would be a new election sometime in June. The pressure on the markets, especially on the single currency, remains quite heavy, as the euro against dollar is in the near-term consolidative mode after extending losses 2 days ago to 129.50 zone, with the negative studies still keeping the focus on the downside, with similar situation with the sterling, as the pair holds just above 161 level, and the focus still to the downside. The risk of a longer-term UK slump is seen on the jobs, on retail sales, as they posted their biggest fall in more than a year last month, and the growth in the number of people placed in a permanent job in Britain slowed. That is raising the risk of another quarter of economic contraction. The bleak news from retailers will further complicate the Bank of England's tomorrow's decision on whether to give another cash boost to the economy, which slipped into recession at the beginning of the year. The Central Bank of England faces the dilemma of balancing weak growth with the stubbornly high inflation. The British Retail Consortium said that like-for-like retail sales, or sales at stores open at least a year, plunged by 3.3% in value terms compared to April 2011, and following a 1.3% rise in March. The reading, the weakest since March last year, confounded analysts' forecast for a 0.5% increase. Shopping in March received an extra boost from unusually warm weather, which contributed to the biggest increase in British retail sales in more than a year, according to the latest figures from the Office for National Statistics. The biggest loser of yesterday was gold, that dropped over $40, hitting the 4-month low. This morning, the yellow metal remains pressured by weaker euro, as investors fretted about political upheaval in Greece that threatens to sink the country into chaos and endanger the eurozone's effort to end the debt crisis. The spot gold dropped as low as $15.86 an ounce, unseen level unseen since early January, extending its 2% slide from the previous session. Currently, it trades around $15.90 per ounce, and it keeps the focus at the downside, as most of the studies, actually all the studies are still pointing, from technical point of view, are pointing lower, and current uncertainty in Europe has prompted, and Europe and also from America, has prompted the investors out of the yellow metal that usually acts as a strong safe haven instrument. From commodities, the oil also is at close to its lowest points, as a recent dip on Monday reached 95.33, with yesterday's spike lower hitting 95.52, just a few ticks above this level, with the overall picture being extremely negative for crude oil price, as the current extension and increase of the current crisis increases fears of investors for a possible lower demand for the energies in the coming period of time, and that's basically the main driver of the crude oil currently. As if you remember, in our previous sessions, we discussed a lot about oil, that unrealistic high prices for crude oil were excused by reduced production from Iran, and Libya. However, at the same time, the Saudi Arabia interfered and increased their production, even opening way for possible full production of 250,000, if I'm not mistaken, barrels per day in case of need. Now we can see that basically it wasn't that much. The problem was not that much due to the production, as much as it was more political problem, and basically the oil is now heading lower towards the levels that Gulf oil producers that are known as the doves in the OPEC bloc see as ideal and quite realistic price for gold, that is around $80 to $90 per barrel. From today's calendar, that is not very big. Few things. The trade balance from Japan came out. Pardon, the Japanese leading indicators, there is a mistake in the calendar, came at 96.6%, slightly below the forecast at 97%, but above the February's release at 96.3, and surprisingly increase in the Germans trade surplus for March, 13.7 billion euros versus 13.6 billion euros of month of February, and today's forecast at 13.4, which sees the positive tone in the German economy, as the Germany remains the strongest, currently the strongest economy in the Eurozone, and the main paymaster for all the cash-strapped countries. Further still to come from US at 1400 GMT wholesale inventories for March. Decrease from the February's release at 0.9% is forecasted at 0.6%. The most interesting release definitely will be crude oil, US crude oil inventories weekly release, that is due at 1430 GMT, and another increase in the oil stocks is seen for today, built by 2 million barrels compared to 2.8 million barrels increase of the previous release, and this is the succession of the past a few weeks that show the US crude stocks being increased at every release. No single time there was any draw in the stocks. That basically shows that demand is slowing down for the energies, and that's also one of the reasons for the current fall of the oil price. With today's release, that will show whether it comes along the expectations or even higher, that will be additional pressure for the oil's price. We're going to take a quick look now in the currencies and commodities to see the past 24 hours movements. As said at the introduction, the euro is consolidating recent losses that dipped to 129.53 on Monday, with the negative outlook still on the hourly chart, keeping the downside favored, as the recovery attempt was short-lived and limited at 130.60, just ahead of weekly close at 130.80, and psychological and round figure resistance at 131.00, as long as where is also the 55 days exponential moving average. As long as these levels stay intact, the immediate focus will be on the downside, as also the 4-hour studies are negative, but in a way stretched indicators might signal some corrective action, as the pair is currently attempting to base at 129.50. A quite negative outlook is seen on the daily chart after price action broke through the strong support and the multi-month range floor at 130 on the upside and 129.50 on the downside. That is the limit of 61.8 Fibonacci retracement, loss of which is to signal further bear phase and the open way towards 129 as round figure support and 128.75 lows of January 2012, as well as January 2011 as our next key support. Nothing much to be seen as long as on the upside, as long as 130.80, 131.00 holds, as I said, and the only break above, firm break above 131 would provide the near-term relief. The key near-term barrier is still is a bit higher. 131.80 is the near-term double top of 3rd and 4th of May. And basically this regain of this level is required to avert immediate downside risk and bring the pair back to the range, with the recent peak at 132.82 of 1st of May 2012 to come in focus. For now, negative tone and negative sentiment in the markets still favors the downside for possible retest and break of our initial support at 129.53, also Fibonacci support. That will open way for further easing of the euro-dollar as a part of the broader down move from 129.82 1st of May peak. Similar to euro, the cable is also in the down move of 163.00, 30th of April peak, with the support being found at 161.13. That also marks 38.2% Fibonacci retracement of move from 158.17 to 163.00, as the pair is still consolidating around above this level, but short-term outlook is more negative and keeps the downside vulnerable, with the levels initial barrier at 161.68. This is yesterday's intraday high, and the more significant high of 162 that capped the upside yesterday, break of which is basically required to avert immediate downside risk and allow for a stronger recovery towards the next barrier at 162.50. A failure to clear 161.68 and 162 might keep still the pair in the current sideways movements, but the downside, as said, will remain vulnerable, with break below 161.13 and 161.00 as a round figure support to open more significant break point at 160.80, 160.60, a higher platform of 23rd and 25th of April, as well as spike high of 2nd of April 2012 at 160.61, a break of which would trigger a stronger reversal and mark the temporary top at 163.00 and open 160.00 as the next target, 61.8% Fibonacci retracement and around the figure support. The dollar-yen's downtrend still remains intact. However, the pair is currently attempting to base at 79.60.50. Strong support zone lows of 1st and 7th of May 2012, as well as 79.52 October 2011 post-intervention peak. And this zone now offers quite good support with the current sideways movement consolidating the recent losses. Negative tone dominates on the larger time frames as daily outlook keeps the downside favored after the pair broke 90 days moving average, currently at 79.93, opening way for further weakness as all studies are holding below their midlines and still pointing lower with no signs of any reversal seen so far. That makes the current movements seen as corrective and consolidative ahead of a fresh leg lower. As long as 80.00 as initial barrier and more significant 80.60 zone, where are the previous peaks of 2nd and 3rd of May, as well as main bear trend line drawn of 84.08 peak stay intact. Only break above this level and regain of 81.00 would provide near-term relief and avert immediate downside risk in favor of stronger correction that will open a next significant barrier at 81.68, 81.77 levels. Dollar Swiss is currently holding just below the previous peak of 7th of May at 92.69 as a brief corrective pullback found support at 92 zone. Our initial support that offers actually this 92.00, 91.80 last week's closing level after the pair opened with the gap higher on Monday, offering quite good support, and the gap hasn't been fully filled so far, keeping the upside in focus as the quick recovery returned back just a few ticks below our target at 92.69, hitting 92.61 in the early hours of today. Positive tone dominates on the near-term studies with quite stretched indicators on the 4-hour chart, still seeing risk of further corrective action before the pair resumes higher. Immediate dynamic support lies at of 20 days moving average lies at 92.11, just ahead of 92.00. Static support and 91.80, and basically only break below 91.80 would weaken the near-term structure and allow for deeper reversal with the next important levels and supports. Dynamic one 91.66, 55 days moving average, 50% retracement at 91.55, and the more significant 91.28, 61.8%, and the near-term double bottom at 91.13, loss of which would refocus 91.00 and the 90.41 low of 1st of April. So far the upside remains in focus and the pair is still in the in the positive territory, just off the recent peak, break of which is required to open next significant barriers, 93.00 peak of 16th of April, also around figure resistance, and the more significant 93.30 highs of 14th and 15th of March 2012, also 61.8% Fibonacci retracement of descent from yearly peak at 95.93 to yearly low at 89.29. A positive tone now is increasing in the daily chart as all studies broke above their midlines and keeping the 92.69 first and then 93.30 in the short-term focus. As said, the gold was the biggest loser yesterday after dipping over $40 to fresh low at 15.86 seen in the early hours of today's trading, with a clear break now below the triangle, longer-term triangle support, and loss of key static supports at 16.23 and 16.12, as well as 16.00 is around the figure support, opening way for a fresh weakness of the yellow metal that persists from yearly high at 17.90 posted on 29th of February, and the previous 8th of November 2011 peak at 1802, turning focus lower towards 1522, 1532, pardon, 1522, 1532 double bottom. That is basically our key medium-term support, as the pair is in the steady downtrend of last year's September record high at 1920, and this was the base built in September to December of reversal from 1920. Loss of these levels would open way for more significant losses and retracement of very steep and strong up move in past 10 years that started from approximately $300 per ounce and peaked at nearly $2,000 per ounce, with no significant correction seen except the one in 2008 until now. And the current situation in the markets with the negative technical points keeping a focus at this very strong support at 1522, 1532, and a possible break of this level, as said, would open way for a more significant correction of the past 10 years uptrend of yellow metal. And finally, a quick look at crude oil, that is also in a steep downtrend from last week's peak at 106.41 that dipped so far to 95.33. The pair attempts again through the 200 days moving average is currently at 96.35 as two brief breaks lower were short-lived so far. However, negative tone that dominates on all time frames keeps the downside firmly in focus, with some corrective action seen just preceding fresh weakness as the oil's price dropped below the first static support at 95.43. Focus hitting 95.33. Break of the later will turn focus down towards next significant static support 92.70, 16th of December 2011 low. On the upside, the $100 per ounce would be seen as the next stronger resistance ahead of 100.67 low of 10th of April 2012, and basically only regain of these levels would provide temporary relief for the currently weak oil prices. But so far a negative tone keeps the downside firmly in focus, and as mentioned in our news part, the main driver of oil prices currently fears of lowering demand worldwide for the energies that keeps investors coming out of their oil positions and basically shorting the oil, as current fears see potential of further deepening of the crisis from both sides of Atlantic and further reduction in demand for the energy. That was all for today. We're back tomorrow at the same time, 7:00 GMT. For all those that connected later or missed to view our session, recorded version will be shortly uploaded to Windsor Brokers page in YouTube called the Windsor Brokers Forex. I wish you a very nice day and very successful trading. Thank you.